On behalf of GVHBA and BC Housing, thank you for attending tonight's forum. So we're doing something a little bit different this year. If you have attended in the past, we've done a series of presentations. Tonight we're just going to move quickly into a Q&A. I'll introduce our panelists, pose a few questions, and then we'll throw it out to you to deal with any comments or questions that you have. So our panelists tonight on my far left, Alisa Aragon, mortgage expert, Bridgestone Financing Pros with DLC Mountain View. With more than 16 years in the real estate industry, Alisa obtained her mortgage license from the University of British Columbia and started her own business in 2011. She recently established Bridgestone Financing Pros with Dominion Lending Centers Mountain View Limited. Alisa is a regular contributor to Real Estate Weekly and the new Home and Condo Guide, Metro Vancouver edition. Tonight, Alisa will review the mortgage outlook, pre-approvals, pre-qualifications, subject to finance, and why rate alone is not a good idea when shopping for a mortgage. Next is John Fries, CIM District Vice President with HomEquity Bank. John joined the HomEquity Bank in January 2010. He is responsible for the development of the reverse mortgage market, focusing on mortgage brokers. Formerly, he held the position of Vice President National Sales for the Ethical Funds Company, focused on growing assets through retail advisor and institutional channels across the country. Prior to that, he was the Vice President National Sales for Credential Group, which was responsible for the national sales and business development functions in the Canadian credit union system, and as a provincial branch manager in Saskatchewan, overseeing the Credential Securities operation. He has over 35 years of experience in the financial service industry with both Canada's largest investment dealer, Merrill Lynch, Midland Walwyn, and various positions with the Royal Bank. Our third speaker is Cindy Faulkner. Cindy has more than 25 years of industry experience in the mortgage and real estate industry. She has been a business owner for more than 22 years and holds a diploma of technology in human resources from BCIT. As a founder of BrokerSmart and co-owner of Verico Coastal Mortgages, she has a wealth of knowledge and experience that makes her one of the top brokers. Cindy works directly with rent-to-own and home share options, and so Cindy will share some information about those tonight. So with that, let's start with Alisa, and I know something that you'll all be interested in. So Alisa, looking ahead through 2018 and into 2019, what are some of the trends that you're seeing in mortgage interest rates?
Well, I guess it's no surprise to everybody. Interest rates have been moving up. It started with Bank of Canada last year. They didn't increase the rates, their prime rate, their overnight lending rate for 7 years. And last summer, they actually increased it. And again, they did it again in September, and they did it again in January of this year. So we are expecting to see more increases. There's obviously different things happening with the economy, the world economy as well. So with NAFTA being a big question there, they probably won't be increasing prime rate at this point. Perhaps there might be 1 or 2 more increases. Now, this will affect directly variable or adjustable rates. So that would be something where if you have lines of credit or loans that are depending on the variable rate, on prime rate, that will actually affect your payments. With fixed rates are actually, the way they get adjusted is based on the bond market. So it's very different compared to the Bank of Canada, the variable rates. So when the bond market goes up, then interest rates go up. If the bond market goes down, then interest rates go down. So as we have seen, we had interest rates were very low, in the low 2%. Now they're in the mid 3%, and they're definitely going to be increasing. We're expecting interest rates to be higher up around closer to the 4%, probably around the summer. And I know we'll be coming to one of the questions later, that interest rate is not the most important thing. But we do expect the days of really low interest rates. Unfortunately, those days are gone.
So why don't you continue, Alisa, and talk about, is the interest rate the main thing that first-time buyers should be concerned about when they're shopping for a mortgage?
Definitely not. It is one component, but I always advise my clients and people is really look at what is the best mortgage with the best rates and the best terms. It's not really about interest rates. Also, since there has been the stress test that happened in October 2016, that majorly impacted first-time buyers. So anybody that is putting less than 20%, they have to qualify at the benchmark of Canada, which right now it's at 5.14. It doesn't mean you're going to be paying that rate, but you do have to qualify at that. So that actually affected a lot of buyers because it reduced how much they're going to be able to qualify for. And then recently, in January 1st, the rules applied for a new stress test for anybody that's that are buying a property over with more than 20% down, and they're having to qualify now. Or if you're looking at refinancing your mortgage, you're looking at qualifying at the greater of 2%, the contract rate plus 2%, or the greater of the benchmark, which is 5.14. So if you're looking at an interest rate, let's just say 3.39, then you're actually qualifying at 5.39. Again, that's not the interest rate you're paying, but that's where you're qualifying. So that has actually reduced the ability for people to buy for about 20% less that they were able to buy before. So when you look at interest rates, again, it's not the only thing you should focus on is what are your prepayment, how are your prepayments going to be if you had to pay out your mortgage earlier. So what are the penalties? Those are huge things you need to look at. How is your mortgage registered? Is it collateral or conventional? Collateral means they're going to be registering at a higher amount. So if your mortgage, say, is $100,000, they will register for $150,000. So that means they say, well, if you need more money, you just come and tell us, and you don't have to go through legal fees again. However, that can limit your options when your mortgage comes up for renewal. Also, what are the prepayment options? So again, look at all the terms and conditions of the mortgage. It's not just the interest rate. As well with the changes that happened. Whenever you see the lowest interest rate, that's not necessarily the interest rate you're going to be paying. Interest rates there's different tiers of interest rates now. The ones that you see advertised really is when you're buying a property less than 20%, which means that you're going to be paying the mortgage default insurance. That is actually included in your mortgage, so it's added onto, you only pay it one time. So those are the lowest rates you will see. The next rate you were looking at, if you're actually qualifying at 25 years at the benchmark, and that's when you're putting more than 20% down. So the rates are a little bit higher there. And then if you're buying a property over $1 million, which technically cannot be insured. I know CMHC will probably talk a little bit about that. So that will mean that it is called uninsured. So that means that you're looking at a higher rate too. If you're looking at buying an investment property, you're looking at a little bit higher interest rate than if you're going to be living in the property. And if you're looking at 25 years amortization period, that's the life of your mortgage, compared to 30 years, then there's a little bit rate. So again, even interest rates now are not as simple as like, okay, this is it. So again, it's really understanding the mortgage. You guys feeling comfortable, and whoever does it, that you're actually comfortable through the whole process, that all your questions are being answered, because this is one of your biggest decisions. I find people that normally spend more time figuring out a 2-year cell phone plan than actually finding the best mortgage. So again, it's looking at what are the best options. Look at the overall mortgage, because in general, people break their mortgage every 3.5 years. It doesn't mean they might sell the property, they might need to refinance, life happens. You might buy it with a spouse or partner, you might split up, there might be a death, there's just so many things. So it's really important to keep your options open.
Maybe before we move on to John and Cindy, Alisa, maybe just explain the pre-qualification process
Sure.
or pre-approval process and why that's so important.
Sure. So pretty well, pre-approval process, the reality is just a rate hold. They're not really looking at your overall, they're not checking your income, they might check your credit, but they're just so they're pretty well just holding their rate between 90 to 120 days. That's the big thing. When you're looking at pre-qualification, the lender is, they're looking more at your documents. They're actually reviewing the documents, and that's when you work with a mortgage expert. They look at more information, like what's your income, where is the down payment coming from. So they actually qualify you a lot more than it's just holding a rate, because the reality rate holds nowadays don't really mean much. They're just holding that rate. So those are very important things, because when you're applying for a mortgage, there's three key things the lenders really need to sign off on. And perhaps with this very competitive market, is like a lot of people are going subject free. That is a huge risk on doing that, because there's three things the lender has to sign off. One is your income, the other one is the down payment, and the other one is the property. Especially if you're buying a strata, like a condo or a townhome, they need to be comfortable with the property as well. And if you're putting less than 20% down, the insurer has to be approve the property as well. So those are the risks that, again, just going subject free can be a huge risk. There's different strategies to be able to do that. But if not, you can actually lose the deposit that you actually end up putting on that property.
Great. Thank you, Alisa. Move on to Cindy now. Could you describe for us, Cindy, what exactly a rent-to-own option is?
Is this on?
I think so.
Hello?
Yep.
Perfect. Before I answer your question, I just wanted to let you know I'm both a mortgage broker and a realtor, so I own both a mortgage company and a real estate company, so I'll try to keep things to... I'm using my iPad, so I just have points made here because I can ramble on into other different areas because they cross over. And if I know of the people online, if they actually want to email me after, or if there's any questions that they have, they can email me at cindy@coastalmortgages.ca. Okay? So to your question, rent to own. These are, so when you're purchasing a rent to own, you're purchasing the option to purchase that home in the future. And where your down payment comes from is part of the rent. So for example, if you are going to purchase this property, you will have rent for, say, market rent of $200 or $2,000, and $1,000 of it is for your down payment. Over, a 5-year term, you would have $6,000 or $60,000 there that would go towards your down payment. Rent-owns are really difficult in this kind of market because you really need to, or the banks don't really like funding them anymore in this up market, because there is the prices are just increasing. They're not really very popular at this moment. When you do a rent-to-own, you have to really make sure that you have a very solid contract written, because you're writing an offer on a property right now, which is a lease, basically, but you are, let's say, for example, you're writing to buy a house for $800,000, which is going to be in Abbotsford because you can't get them in Vancouver. You would need to say, okay, I'm going to write this offer now, and in 5 years, I'm going to buy it for $800,000. So do you think a vendor's really going to want to do that in today's market? It's not really something that people are wanting to do at this time. Plus, when the lenders go to finance this in 5 years' time, there's a danger that you may not qualify because the interest rates may go up. So it's actually a little bit of a dangerous situation to be in. And you could possibly lose your down payment that you've been paying over the 5-year term.
So rent-to-own doesn't sound like a very...
Sorry, I know I'm not trying to paint it with a broad brush. In
Yes.
the past, it was really good. It's for people that, had rented a property for a long period of time and basically went to their owners and said, or their landlord and said, I'd like to buy this property. I've been here for 5 years or 10 years. Can you sell it to me? That's when it was very popular, when the market was more of a stable market. But because in the last 5 years it's just, increased dramatically, it's not as popular. And the lenders don't really like it right now too, because of they can't really qualify where the down payment's coming from. So it's fraud, money laundering that they're really worried about.
How about home shares or a shared equity strategy?
Yeah. So home shares, which is a partnership, is becoming more popular because the homes in Vancouver are more expensive. So if you look at your average home in East Vancouver, $1.4 million, you'll get. This has become more popular. So what we're seeing right now is we're seeing couples come in and they're saying, well, you know what, I can afford $700,000 property, but I can't afford a $1.4 million. So two couples come to us and they end up putting a partnership agreement together and they buy a home together. So one person lives in the top, one person lives in the bottom. And that really works well for a lot of people. But the one thing about doing that is that you want to make sure that you have a really good contract written up front, because things do change for people in a partnership. There is some benefits of doing a partnership. One is that you shared risk, shared costs for replacing roofs and hot water tanks and all those types of things. And also for qualifying too, if you are going into a partnership, one person might have a lot of income but very limited credit, where other people have really good credit but limited income. It works really well.
Are you seeing more and more of those kinds of opportunities given the rising market?
Yeah.
Yeah.
Yeah, we're seeing more and more people want to do that because
Right.
it's just so expensive out there.
Right.
Yeah.
Good. Maybe.
Sorry.
Alyssa?
I would agree, and a lot of it has happened also with investment properties.
Yeah.
Clients buying also investment property instead of just your owner-occupied or your
Yeah.
principal residence. So, yeah, that's
I
definitely
know,
coming
I
more
know,
common. Thinking outside
and
the
I
box.
Right.
And then there,
Interesting.
of course, there's the parents that gift money too, so that's another thing that happens, another partnership. And then there's a third partnership, but it's more or less in Whistler, and you can buy quarter share, half share, and that's another way to get into the market. But those are more for recreational and a revenue stream too.
Right. Great.
Yeah.
Thank you, Cindy. Maybe move on to John now. John's an expert in a reverse mortgage. So maybe, John, you could explain what a reverse mortgage is and what are some of the benefits of a reverse mortgage and how you can use it to help unlock some equity to help a family member purchase.
Sure. First, I'll state that HomEquity Bank's been in business since 1986, so we've been around for a while. We're dedicated to the 55-plus market. So we're the only company in Canada that offers reverse mortgages as the only thing that we do. So we're pretty proficient at that. So for our market, the 55-plus crowd, it's really been driven a lot in a recent past by the significant increase in values in home prices here in Vancouver and Toronto. So it's a way for homeowners to unlock some of that newfound equity in their home to use for lots of different things. And one of the things that they're focused on, I'm 65, so I'm in our demographic, is taking equity out of their home to provide to their children as down payments so they can get into the housing market. So when OSFI changes regulations to make it more difficult for first-time home buyers to get into the market, that actually is very well for our business, because then typically they go to what you said in your program, the bank of mom and dad, looking for some extra funds to make up for that down payment. So really, it's an equity takeout strategy. What a reverse mortgage is, people are kind of get confused sometimes. In our business, we call a traditional mortgage a forward mortgage. We mean by that is you make a regular monthly or biweekly or weekly principal and interest payment. So the balance comes down over time, 25 or 30 years. With a reverse mortgage, you borrow money, or we lend you money, you don't make any payments. We still charge interest. So the interest is added on to the mortgage, or capitalized, and the balance, instead of going down over time, grows over time, okay? So the upside is seniors get to stay in their home, or 55 plus, if you don't want to be called a senior. They get to help out their children, or buy an investment property, which a lot of our clients do, or a lot of our clients who are retired are snowbirds, want to buy a place in the States so they can get rid of or get out of the rain for 3 months of the year, etc. So it's just a way to access the equity in their home. The only other way to do it, in my humble opinion, is to sell the house. So you either sell the house to get the equity, or you borrow against the house to get the equity. Those are really the only two ways you can get it. So it's a strategy that's been extremely popular and growing by leaps and bounds.
Great. What is the percent of equity that a borrower could take out of their home?
Oh, good question. We will lend up to 55% of the value of the property, and the value of the property is determined by a market value appraisal. So current market value doesn't go by your property assessment, because typically that's really not reflective of what the value is at any given point in time. It is age-based as to how much you can take. So as an example, our starting age is 55. So if you're 55 and your wife is 55, you both have to be 55. You can only borrow about 25 to 28% of the value of your home or your property. If you're 70 years old, you can borrow about 40 to 45%. So the older you are, the more we will lend. And it's simply, if you think of life insurance and actuary tables, it's really based around life expectancy and how long we anticipate that you're going to stay in the home. Okay, does that answer your question?
Yeah, great. Alisa, John, or Sydney, any final comments that you want to make before we open it up to the audience for questions? Just any comment?
There is, I know it's really difficult for people to get into homes right now. There's another really good strategy, and it's with a vendor take back.
Yeah.
Got my mics there, sorry. A vendor take back is another option because it is becoming more difficult for people to qualify to get to go to the bank and qualify at the bank. The vendor take back is a good option. So what happens there is that if I owned a home and you want to buy the home for me, you would give me, let's say 10% down, and then I would hold the mortgage on that property for you. This is a really good option if people can't qualify at the banks because they are making it more difficult to qualify. So look at other strategies is what I'm saying.
And I would only add to that, for reverse mortgage from a qualification perspective, it's a lot easier than your traditional bank, even though we are a bank and governed by the same regulations. To qualify for reverse mortgage, it has to be your home, you have to be over 55 years old, and you have to show enough income to pay for your property tax and your home insurance policy. That's it. So there's no debt serviceability requirement. So as I said, when the Bank of Canada or the lenders make changes to the lending criteria, it doesn't affect us because our lending criteria and qualifications are quite a bit different. So we get a lot of clients who get turned down by their bank or their credit union who get sent to us because we're the only lender or one of the only lenders that's available to be able to help them out.
I guess if one advice I would give you guys and clients or anybody buying a property is not only what you actually are qualified to buy, is what you're comfortably paying on a monthly basis. Because you don't want to just, most people are like, what is the maximum amount I qualify? It's like, yes, I will give you that. But also, what are you comfortably paying on a monthly basis? Because you don't want to be house rich and money poor, that everything you earn goes to the house and not what you actually, for you to live, have fun and maintain the lifestyle that you have. Yes, you might make some cuts here and there. However, it's really about what you're comfortably paying on a monthly basis, and take into account you're going to have to pay property taxes and strata fees if you're buying a condo or a townhome. So those are things that you need to kind of, it really helps for you to, just a penny for thought when you're looking at buying a home.
Great, thank you. Now we'll open it up to those in the audience and those on the line. Any comments, questions that folks have of our panelists? One there. Dawn, are we using the microphone?
Yeah.
Great.
Hi, I have a question about the reverse mortgage. Are your interest rates competitive with the regular interest rates?
Yeah, I would say our interest rates are competitive. I would agree with Alisa first, is interest rate's not the most important thing when when you're looking at a reverse mortgage. So our rates are higher, roughly 2 to 2.5% higher than your traditional bank rate, lower than some of the rates that you see advertised on TV by some of the alternate lenders. So we kind of occupy the middle ground. Did that answer your question?
Yes, it does.
Okay.
Thank you.
Can I make a comment?
Sure.
One thing that happens is our parents and our grandparents were raised to pretty well pay off your mortgage, don't have a mortgage. And a lot of seniors and older individuals have no mortgage in their homes, which is a great thing. However, everything they earned went straight to there, and they don't have liquid assets. So again, it's about having a balance. This is where the home equity plan really comes into play and really helps out. There used to be equity lending. There's still a little bit of it where you're able to take equity out of your home, but you still have to qualify. So that can be a little bit of a challenge. So then definitely that's when home equity helps, because what lenders look at the equity lending is looking at a balance of real estate, but also liquid assets. So that would be investments and everything else. So it's having a balance of both, and a lot of people don't have that.
Thanks, Alisa. Other comments, questions? Yeah, we have one up here. Somebody will be there in a sec.
I was just wondering if you could give the pros and cons more about the buy to own?
The rent to own?
Yeah, the rent to own, sorry.
Yeah. So would you like to know more?
Just the pros and cons of it in our market. And if you were saying it wouldn't work in our market?
Well, it still works in our market, and there is lenders that will do it for you right now, but it's the vendor, so the homeowner, it doesn't feel as advantageous for them to do it because our market's rising. So what you're doing is you're putting the value on that property today. So let's say, take another example again, the East Van property at 1.4 million. If you did a rent to own on that one, you would do 1.4 million at today's market. You'd write the contract on that. You'd get pre-approved on that, and then you would set a rental rate on that. So let's say it was $4,000. $3,000 would go to the rent, and $1,000 would go to the vendor for saving for the down payment. Now, in 5 years, that lease would come up. It's called a contract lease. That would come up in 5 years. So, could you afford it in 5 years if the interest rates are up 2% more? Would you be able to afford that, $1.3 million mortgage? Would the owner have lost out a bunch of money because are our prices still going to continue? Is that $1.4 million property going to be worth $2.5 million in 5 years? None of us really know.
Would it work in a shorter term, like 1 or 2 years?
Well, you're not going to be able to collect enough down payment in that short period of time, because what happens with the lenders right now, they want the market rent plus on top of that. So, and that gets registered too on the title. So what they want to know is, okay, you're renting it. There again, the same example. You're renting this for $4,000. $3,000 is going towards the rent, and $1,000 is going towards the down payment. So in 12 months' time, you'd only have saved $12,000. So that's not a lot of money going towards a $1.4 million property. Because that's why people do it or rent own, because they haven't saved enough money for their down payment.
Okay.
Did that answer your question?
Yes.
Thank you.
Question back there.
Thanks. Hi, I'd like to help my children buy a home. Cindy, you mentioned that a shared home purchase is one approach to perhaps do that. So what are the drawbacks of that, and what might other approaches be to help my children buy a home? What other approaches might I consider instead?
Well, where's the money coming from, the down payment?
Okay. From me.
Okay. So you could do an equity takeout. Reverse purchase. So the money's coming down. Well, so are you concerned about what happens if they have a partner in that?
That's one of the issues, yes.
Yeah, that generally is. I see a lot of that happen right now, where people are gifting their kids the down payment, and they're going, okay, well, how am I going to protect that for me and for my partner? So if you have, for example, if your daughter, you're giving her, and we're going to go back to that $1.4 million example, just because we're already on it. Let's just say you gave her $500,000 for the down payment, and then she went and got a loan on that, and then her partner moved in with her. What you can do is you can register a mortgage on title from you, so that if anything happened to her and her partner, then the partner wouldn't be able to take your down payment and everything, so that you would get your down payment paid out first at the $500,000, and then the other half would be split. But it really depends, because there is some new rulings out there. I'm not going to get into too much law here, but there is some new rules in place, because before, what I would see happen is couples would get into would move in with each other, and then they'd split up 6 months later, and that one person that left, that came in with nothing, would go out with half the money. And that wasn't fair. So there was a new ruling that was put out almost 2 years ago. And it's basically what you came in with the relationship, you leave with the relationship with.
I just add to that as well. Get yourself a lawyer. Make sure you paper it over, and have both of them sign a demand promissory note as a loan, in addition to if you're going to register the mortgage. And I'm speaking from personal experience.
Alisa, any comments? No? Okay, great. We have a question up front here.
Sorry, I want to go back to the previous points you were making, being in the same position of wanting to help a child. I was confused by that. If you are gifting your children a down payment, I thought that they couldn't get a mortgage if you then had them sign something saying that they had to pay you back.
That's gifted money. Yeah, so you don't have to actually. Generally, what happens is the lenders do want you to sign it, saying that you're gifting that money to them, and that they're going to pay it back to you. Most of the time, that never happens. The parents are gifting them the money. So what happens is, in a partnership agreement, you could go in and gift your daughter, if it was your daughter, the $500,000 on the $1.4 million, and you could be put on title as 1% owner too, to protect your $500,000 if you wanted to. There's a number of different ways you can protect yourself.
Okay, and where would I learn more about that?
A lawyer.
A lawyer.
Yeah,
Okay.
sorry. I know. I can talk to you after a little bit more about it after.
I have been in that situation, and I didn't gift to my daughter $500,000. It was more like $50,000 on a less expensive condo. But we, in fact, did register that 1% interest, and that was based on legal advice to protect the interest, and it was purely in the daughter was moving in with her boyfriend, and you don't like to consider those things, but you have to. So
yeah, can I just speak to that? There also is a lot of other rules that are changing right now, because when you do gift them and you are on title for 1%, you might have to pay capital gains on that. So I have somebody that you could talk to about that if you'd like. I can give you her number after this. Okay, to protect yourself.
You need an accountant as well as a lawyer.
any other comments, questions for our panelists? One back there.
Regarding the reverse mortgage, you mentioned interest rate is not the only thing to consider. So specifically with a reverse mortgage, what are some terms we should look out for that might result in your company owning more than what's borrowed plus interest, or any other pitfalls?
Well, I say the most important thing about any type of lending product is cash flow. And I think Alisa alluded to that in a different way. You know, you got to have a lifestyle. Everything can't be going to a mortgage payment. So that's what I really mean about interest rate is not the most important factor when you're looking at borrowing money. It's the impact it has on your cash flow, either positive or negative. With a reverse mortgage, and I'll just state it again, it's a mortgage that does not require a payment of principal or interest. Those are optional. You can make a principal payment, so a lump sum payment, 10% once a year. you can set up regular monthly interest payments as well. Typically, our clients don't do so because when you're making a payment, it's taking away from cash flow. So the upside is staying in your house and being able to take advantage of further increases in values of your home, so increasing the equity. If you sell your home, you've sold your asset, what are you going to do? You're going to buy something less expensive, and you're going to spend some of the equity. So you're spending the equity anyways. It's a way of staying in your home and still spending some of the equity. Here's the downside. Markets, housing markets, and I used to be in the investment business, markets don't go up forever. So there could be a correction. I don't know when it will be, or how much it will be, or how long it will last. You can look at a housing chart for the Greater Vancouver area the last 50 years, and it goes like this. Over the long haul, it will go up, but there will be peaks and valleys in between. So you could take out a reverse mortgage today and end up selling the property at one of the valleys rather than at one of the peaks. No different than buying an investment or an investment property hoping to capture a capital gain in the future, only to realize that maybe the future you're in a depressed market and you can't sell it for what you want to sell it for. So really, that's really, in my view, is the pitfall, the upside and the downside.
What about terms in that contract?
Terms, we have interest terms, so you can take a 6-month, 1-year, 3-year, 5-year fixed term. So you can fix the interest rate for a period of time. We have a variable as well. The only other thing is here that you need to be concerned about is what are your obligations with a reverse mortgage if you don't have to make a payment? Your obligations are, it's your principal residence. So you live in a house. Your obligation is to pay property taxes. In BC, we're very lucky. We have this thing called deferred property tax. Once a reverse mortgage is registered, you can actually defer your property tax behind it. Again, depending upon the effect you want it to have on your cash flow. 3, you have to maintain house insurance. You have a house, if it burns down, that's our security. And the other condition is not to go bankrupt. Because if you go bankrupt, chances are you're going to have to sell your house. Those are the conditions and the terms. It can be paid off at any time, so it's not a closed mortgage. And like any mortgage, a mortgage comes with various prepayment penalties. And those are clearly outlined in our contract.
We'll go to Vanessa. We have an online question. Vanessa?
Yeah, so this question's from Gary. He's also asking about reverse mortgages. He's asking if someone pays off the loan in the future, does that cancel? And then the owner has no mortgage charge on title.
Yeah, like any mortgage, think of a reverse mortgage like a traditional mortgage. When you pay the mortgage off, we give you a discharge of mortgage. The discharge gets registered, and then the home becomes free and clear again. Okay? It's just a mortgage.
We got time for 1 or 2 more questions if anyone in the audience has one. Yeah, one back there.
Hi, would you be able to expand on the vendor take-back?
Yeah, so did you just want to know how it all would work? Okay. So there again, I'll put myself as I'm the owner of the property. So I own a $1.4 million property, and you want to buy my property. I would probably want a minimum of 20% down from you, and the rest I would carry in a mortgage. I would be like the bank. So I would set a interest rate, and I would set a term on it. So I'd probably set a 5-year term at probably 5.5%. So it's a little bit higher than going to the traditional bank, but because it's a little bit more risky for myself as just one homeowner. So that's how it works. Did that answer your question? Okay.
Do things like stress tests apply to vendor take-back mortgages?
No.
One last question in the audience, if anyone has one. Yeah, one over here.
Thank you for taking my question. My question is a mortgage question, and can you please explain the pros and cons of an open interest rate as compared to a closed one?
Yes. Open rates are usually for a shorter period of time. So, and usually open rates are actually a lot higher. So, for example, if you have your house and your mortgage is coming up for renewal, and you know you're going to be selling your house, are going to be doing something else, it might not make sense for you to locking into a long-term mortgage. So you just leave it open. Some lenders do allow you to do that, some other ones don't. And then a closed mortgage means, and that's most of the mortgages we see and that people go into, so pretty well means that mortgage is closed for that period of time. Typically it's 5 years. Now they're coming back into, they stopped coming in, but now you can actually get mortgages up to 7 years or 10 years. So because interest rates are starting to climb up, people are saying, you know what, maybe I will lock in now for 7 years or 10 years. When interest rates started coming down, they pretty well disappeared, but lenders are starting to bring them back. But that means you're going to be locked in for that term, for that period of time. So that could be a variable mortgage or a fixed mortgage. Because for a variable mortgage, you only pay 3-month penalty interest. For fixed mortgage, you pay the greater of the interest rate differential, which means the interest rate that you're paying compared to the current interest rate and how much is left on your term. So that's how it's calculated, or the 3-month penalty interest. Most times, the interest rate differential is higher. Does that answer your question? Yeah. Okay. Awesome.
Great. So please join me in thanking Alisa, John, and Sydney for their great comments tonight. And thank you for all your great questions, and be sure to stay with us for the next panel, Understanding Your Local Market. That will feature information on the current state of the market from Eric Bond, Principal Market Analyst from Canada Mortgage and Housing, and Scott Brown, President of Fifth Avenue Real Estate Marketing, and they'll cover topics including pricing, pre-sales, product trends, new neighborhoods to keep an eye on, and who is buying and why. For those of you in the audience, please take the time to visit our market outside. And our folks at the various booths will be happy to answer any other questions that you have. I would also ask you, there is a survey in your bag. Please take the time to fill that out. We'd really appreciate your comments on the new format that we've introduced this year, what your thoughts are on it, because I know Dawn and her team at GVHBA are always looking at ways to improve it. If you do fill out the survey and put it in, there will be a prize at the end of the fourth session, a pair of Beats headphones. Again, we'd like to thank all of our sponsors tonight. Without them, we couldn't put it on. So thank you very much, and we'll see you back at 6 o'clock.